At 5:11 in the morning, a file arrived, an automated file generated by a computer and sent to Robinhood's operations team while most of the US was asleep. It contained one number, $3.7 billion, the amount Robinhood was required to post to its clearinghouse before the market opened. Robinhood had $696 million already on deposit, which left a gap of approximately $3 billion, with a deadline of roughly 4 hours and 19 minutes away. By the time the opening bell rang, Robinhood's customers could sell GameStop shares. They just couldn't buy them. Robinhood, in its own words, had moved the securities to position closing only status. That decision, the one that generated congressional investigations and more than 30 class action lawsuits, was not a conspiracy. It was arithmetic. In late January 2021, GameStop's share price had risen more than 530% in 3 days. The House Financial Services Committee's memorandum on the event puts the intraday high at $483. Retail traders gathering on the Reddit forum Wall Street Bets had identified that institutions were heavily short on the stock and had bought in volume, forcing those institutions to buy back at rising prices to limit their losses. That only made the prices rise even more. That cycle is called a short squeeze. The clearinghouse watched all of this through one lens only: risk. Every US stock trade, every share bought or sold on an American exchange passes through the National Securities Clearing Corporation, the NSCC. The NSCC is a subsidiary of the Deposit Trust and Clearing Corporation, the DTCC, the institution that oversees clearing and settlement across US markets. When you buy a stock, the money and the shares do not actually exchange hands for 2 days. The gap, 2 business days known as T+2, existed in every trade placed on every American exchange. And for those 2 days, the NSCC was the institution guaranteeing the trade would complete, regardless of what happened to either side. The seller disappears, the buyer still gets their shares. The buyer disappears, the seller still gets paid. To absorb that risk, the NSCC requires every broker-dealer to post collateral, called a clearing fund deposit, that is calculated daily based on the risk the NSCC is carrying on their behalf. Under normal conditions, this charge is predictable, it's manageable, the kind of number a compliance team models in advance and just forgets about. Robinhood had modeled it. They had prepared for approximately $1.4 billion. That preparation would account for less than half of what arrived at 5:11 in the morning. Robinhood CEO Vladimir Tenev published a statement on February 18, 2021. The daily deposit requirement on January 28th, he wrote, was 10 times what it had been just 4 days earlier. 10 times the charge in 4 days. The model did not have an opinion about Reddit. It had only one input that mattered. How much money could the NSCC lose if Robinhood failed to settle its open positions given the current market volatility? In the industry, this is called value at risk, or VAR. That week, it was climbing fast. Robinhood's VAR deposit requirement, the base clearing fund charge, had stood at $696 million on January 27th, the day before. By the morning of January 28th, Tenev told the House Financial Service Committee it had risen to approximately $1.3 billion. But there was a second charge, one Robinhood had never seen coming. The excess capital premium is a separate NSCC rule. It activates when that risk becomes larger than the capital the firm itself is required to hold. Think of a bank overdraft fee. It charges a fixed amount when you go below zero. Only this one doesn't work that way. The further you breach the threshold, the larger the surcharge, automatically by formula. Cross it by enough, and the formula produces a number that arrives at 5:11 in the morning. Robinhood's value at risk charge had exceeded its net capital, so the premium triggered $2.2 billion on top of everything else. The total requirement stood at $3.7 billion. Robinhood had on deposit $696 million. The deficit was approximately $3 billion. The House Financial Services Committee spent 17 months on this, 95,000 pages of documents, conducted more than 50 interviews. On the morning of January 28th, after the automated notice had already arrived, Robinhood's operational staff accessed, for the first time, the publicly available formula the NSCC uses to calculate the excess capital premium charge. That formula, the committee's report notes, is contained in the NSCC's own published rulebook. The formula had been there the whole time. 3 weeks after the event, on February 18th, the firm built an internal model for the charge. 4 months after that, they began running it regularly. The charge that nearly ended the company had been calculable by anyone with a membership and an internet connection. Robinhood ran the numbers for the first time on the morning the bill arrived. Robinhood notified the DTCC officials it could not meet its obligations. At 6:29 in the morning, Robinhood's clearing operations president, Jim Swarthout, sent a message to the company's COO, Gretchen Howard. Huge liquidity issue. Then, at 7:15, Robinhood's chief legal officer, Dan Gallagher, called the DTCC. The committee's report records is asked to discuss how to obtain relief, waiver, or an exemption. In the hours that followed, the firm imposed purchasing restrictions on the securities driving the charge. Shortly after 9 a.m., the NSCC informed Robinhood that the excess capital premium charge had been waived entirely for that day. The House Committee's timeline places the revised total approximately $1.4 billion as confirmed at around 9:11 in the morning. Robinhood raised the funds to meet it. The market opened at 9:30. For those securities, the buy button was already gone. The House Financial Services Committee's memorandum records GameStop's closing price on January 28th, $193.60, down 44.3% from the prior day. Customers who owned restricted securities during that period were, in the committee's memorandum's words, left holding the bag. The waiver extended beyond Robinhood. The House Committee's findings document $9.7 billion in collateral deposit requirements waived across all member firms on January 28th alone. The committee also found the DTCC lacked detailed written policies governing when such waivers could be granted. In October 2021, the SEC staff published a report on stock events. On the collateral calls, the staff found they were consistent with the NSCC rules as they existed. The report did not characterize the resulting trading restrictions as a violation of securities law. What it noted was that the episode raised questions about the settlement cycle itself, the 2-day window at the center of the whole mechanism. Early 2023, 2 years after the events, the SEC adopted a rule shortening U.S. equity settlement from T+2 to T+1. Compliance became mandatory 1 year after. The SEC rulemaking documents stated that a shorter settlement window reduces the period during which clearinghouses carrying counterparty risk, and therefore reduces the size of the collateral deposits they require members to maintain. Whether a smaller charge on the morning of January 28th would have changed what happened is not something the SEC's rulemaking documents state. However, the rule was changed. Here is what the public record shows. In 2021, DTCC's figures put a total at approximately $2.37 quadrillion in securities transactions, roughly a century's worth of US economic output. The infrastructure runs invisibly, automatically, every trading day. The guarantee behind every trade placed on every American exchange. On January 28, 2021, it sent an automated file at 5:11 in the morning. The file contained a number produced by a formula it had been sitting in the NSCC rulebook for years. A number the firm receiving it had never calculated before that moment. The settlement window has since been cut in half. The formula is still in a rulebook. Make of that what you will.